Welcome to our JTalks Podcast, where leading advisors find the fuel to drive their business alpha. InsurMark is an advisor development organization. This is the next step in our 35-year history of aligning the independent financial advisor with best-of-breed resources and services from a dedicated professional team, product partners, technology vendors, practice management leaders, and business development systems. Today, Jack Martin, our strategic marketing consultant and founder of Elite Advisor Group, will be talking with Dr. Roger Ibbotson about his latest research and why financial advisors should consider the fixed index annuity a bond alternative. Dr. Ibbotson is an economist and creator of the iconic Stock, Bonds, Bills, and Inflation chart. He is Professor Emeritus of Finance at the Yale School of Management. He is a member and the chairman of Zebra Capital Management, LLC. We are also joined by John Holmgren, who is the president of Zebra Capital Management. And now, let's join Jack and Dr. Ibbotson.
Hello, Dr. Ibbotson. Hey, thanks for joining us on the JTalks Podcast today. It looks like Yale might win the Ivy League in football again.
Well, I'm certainly hoping so, but I'm not going to be an expert on that, although I have attended a game already. So,
yeah. So today, what we want to talk about is your white paper. We want to talk about fixed index annuities and bond alternatives. You started your career as a bond manager at the University of Chicago, right?
Yes, I actually managed the bond portfolio at the University of Chicago, and a very interesting time. It was a time when bond yields were still rising, but they were about ready to hit their peaks in early 1980s, and they got to double digits. So it was an interesting time, but not exactly like today, because today's yields are much lower, of course, although we may have the rising yields.
Right. So what you're thinking about where interest rates and the bond market are today?
Well, I think they are really low, actually, because bonds have actually yielding around 3% today, and this is after a long drop in yields from the early 80s when they were double digits, falling all the way to 3%. So it's been a time when people historically have really yielded great returns on bonds, because during that period of drop, they actually had the high yield, plus they actually got a capital gain from the drop in yields. The way a bond works is you get the yield, and then when the yield drops, you're holding the higher yielding bonds, and your bonds go up in price. So people have, for decades, have really realized not only that yield, but substantial capital gains in bonds.
In the title of your white paper, you use the term bond alternatives. So help our audience understand what that means and why we need to be thinking about those today.
Well, you can see why we might need a bond alternative when you think of today's yields now, because now they are at that 3%. Where are they going to go from here? They're much more likely to go up than down. And if they go up, you end up with a yield plus a capital loss. And so you can actually have negative returns on your bonds. So we need an alternative, actually. And that's why we looked at this whole situation, because we need to look at some other way of actually taking less risk at the same time getting a decent return. So we need another way to do this. We don't want to have capital losses in our bonds, which we might very much have. We need an alternative.
Do you think investment advisors and investors generally maybe have a little bit of a blind spot about those bond risks?
Well, they do, because they've been so used to actually getting positive big returns on their bonds. So they viewed bonds as really a substantial source of returns. But that's not what's going to happen going forward. Even the 3% is probably a high estimate of what you'll get going forward, because if bond yields rise, you're going to have capital losses. So, yes, they do have a blind spot, and for good reason. They're looking at history. Bonds have served everybody very well historically. It's just that today times are a little bit different, and that today at that low yield, you're not going to get those high returns anymore, and you may even have capital losses.
So is there something in the way that we're wired, or is there something behavioral, behind why people are still so in love with bonds based on what you just said?
Well, people tend to extrapolate, of course. Whatever happened to them last year or last decade, they expect that to happen again. But we actually, bonds have a structure to them. That's not going to happen again. We actually know what the yield is today. And so when you know what that yield is, you know that the only way you're going to get a capital gain is the yields fall further. There's not too much further they could actually fall, but they could rise, definitely. So behaviorally, people tend to look back at the past and think that's the future. But obviously, that's not the case in the bond market.
When you were at Ibbotson back in 2007, you wrote a monograph titled Lifetime Financial Advice. And in that, you discussed investing over one's life cycle. So should investors be concerned about longevity risk with that in mind?
Well, they certainly should. And actually, when you think of the whole life cycle that somebody invests in, actually insurance can kind of play a role in every piece of it. In the early years, people have steady wage income typically, and they can take on a lot of equity risk. But the other thing they often need is life insurance. So life insurance plays a role. Now, as you start approaching retirement, you have to actually take less risk. And here again, insurance can play a role. And here now we're looking at accumulation annuities such as FIAs can play a role in accumulating our capital in a less risky way. And then when you get into retirement, annuities can also play a role, because here in retirement, people need continual income stream. They can have payouts. They don't know how long they're going to live, though, because that's what longevity risk is all about. Of course, we want to live for a long time, but if we do, there's some chance we would run out of money. And actually, the payout annuities actually help to solve that problem, because they pool everybody together so that each one of us can actually get an income stream for the rest of our lives.
So just to follow up on that, conventional wisdom says that as we approach retirement, we want to invest a little bit more conservatively. So what makes those years right before retirement so critical?
Well, those years we've been saving up for retirement, and actually those are the years that actually have your maximum financial wealth, because as you start into retirement, you start withdrawing from that and paying for your retirement. Now, if you have a loss when you have the biggest amount of money at stake, that loss actually can ruin your retirement, really. So they're really important years. And that's why we're recommending in general, and I've always recommended, that as you start approaching retirement, you need to de-risk. You need to take less risk in that portfolio. And of course, the conventional way that's been done was with bonds. But I guess now we have other instruments like fixed index annuities.
And so there's been a lot of conversation about those first few years after retirement and the risks associated with that, sequence of returns and those kinds of things. So are the risks different? Should we have a different perspective on those first few years after retirement? Should we invest a little differently?
Well, they are especially critical because we no longer have the wage income, and we are actually typically making these withdrawals. So the combination of having a relatively large financial stake and withdrawals taking place, and then superimposing on that a return. If you have a bad return here, it's actually going to take a large chunk out of your financial wealth. If you have a bad return much later, it doesn't matter as much because you won't have as much financial capital anyway at that point.
We've been throwing around this term fixed indexed annuities. What is a fixed indexed annuity?
Well, first of all, it's based on an index, and actually it's based on, and it's an insurance contract that is participating in an index. And so in our case, we'll talk about that later a bit, but in our case, it's actually an equity-based index. So if you participate in an index, like in a fixed index annuity, you're getting the upside of that index. Now, because this is an insurance product, it's actually principal protected. So you get the principal protection on the one side, that's insured by the insurance company, and you get some participation in the index, which could be an equity index. And so you get the return, the positive returns, or part of the positive returns of the equity market. At the same time, you have no real downside risk.
So is that what you were talking about in your white paper when you said a major advantage of the FIA is the ability of the insurance provider to transform equity returns into a more tailored risk return profile?
Yes, that's exactly it. Because actually, if you think about what people really want here, they want to participate in the equity market, certainly. But they're afraid to, and they're naturally afraid to, and particularly they're afraid to as they're started approaching retirement. So how do they get that participation? Well, the reason why they're afraid is because they know that stocks can drop, and here's where the insurance company plays such a big role with these fixed index annuities, which if you actually have some principal protection, you're not going to have the losses. At the same time, you're going to get equity exposure on the upside. So this is actually a product, fixed index annuities, that is designed specifically to meet the needs of the investor. And that's why actually we're calling it a tailored product, because it's actually tailored to meet the specific needs of the investor.
So there are a lot of investment advisors we've heard who have a little bit of a bias against annuities. I guess they think FIAs maybe are too complicated, maybe too expensive. Are they right? What are they missing?
Well, they can be complicated, of course. And the reason why they're complicated is because they're tailored. If you buy suits off the rack, they're not going to be as complicated as a tailored suit that actually is designed to fit your real needs. And here, by tailoring it, in this case, this principal protection and equity participation, that combination is by its very nature somewhat complicated. And so any contract that actually gives you that is somewhat complicated. But that's a necessary component of a FIA, and it's there for a reason. Now, the other aspect of this is the potential costs. And people have said that annuities can have costs, like FIAs. Well, let me say that these are really for long-term contracts, and the costs are high if you get in and then you get out, and you have surrender charges and so forth. But these contracts are designed for people who can hold them for the whole term, like 8, 9, 12 years, whatever they select. But the whole term. Once they're held for the whole term, the accrued costs each year are not that high. So the key is that these are for the long-term investor, and I think the key is matching them up. In fact, by having trusted advisors here, match up the right kind of investor with the FIAs. Because once you have the right kind of investor who has that long-term perspective, it's actually meeting their needs, and the costs are not that high.
In your white paper, you talk about an uncapped fixed indexed annuity strategy. What does that mean, and what's the benefit of that approach?
Well, we get equity exposure in these fixed index annuities, and some of them can be capped and some of them are uncapped. Actually, I think the uncapped has the advantage, though, of participating in equity markets, getting equity exposure during some very big years. And so there are years when you can have very high returns in a fixed index annuity. And if you chop that off, of course, it's much harder to get a high return by owning a fixed index annuity. A lot of the benefit comes in some of these great years, and we don't want to cap it, I guess, because if we cap it, we're not going to get that benefit.
So in your white paper, you did a lot of modeling of what different investments would look like, what their performance would look like under different scenarios. And I think it's in charts 11A through 11D where you talk about, what happens to a 60-40 portfolio, a 60-20-20 kind of portfolio, and if interest rates are rising, if there's market volatility. So can you talk a little bit about that modeling that you did did there and how it impacts, the way we look at assets and portfolios?
Yes, we wanted to consider a lot of different scenarios. Of course, the stock market can go up or the stock market can go down. And of course, interest rates I've looked at, particularly they could be flat and unchanged, but they could also rise. So we tried to look at all the combinations of these and see what would happen to different types of portfolios. And the kind of portfolios we looked at were, well, first of all, how would a stock portfolio do and how would a bond portfolio do under these scenarios, but also how would actually most of us would want to put together some diversification in our portfolios. And so we would want to see how a 60-40 stock bond portfolio would do and how a 60-20-20, where we put fixed index annuities in with the stocks and bonds, or just entirely putting in, taking out the bonds entirely and putting in only the annuities in a 60-40 portfolio. Well, we're looking at all these scenarios with the changing interest rates and the changing stock market. It turns out that adding fixed index annuities is generally very favorable. It's mitigating the risk, and for the most part, the returns are very, very good under these scenarios. For example, if the stock market drops and you have a fixed index annuity in the portfolio, that will have that equity exposure, but it will not actually participate fully in the drop of the market because the fixed index annuity itself will be principally protected over the 2 or 3 years.
So over your career, you've done a lot of work on asset allocation, obviously. How do you think FIAs fit into that traditional asset allocation mix? How do they fit on an efficient frontier?
Well, fixed index annuities are essentially lowering the risk of the portfolio, but they're doing it in a way that you're actually getting some equity participation at the same time. So they actually do very well in a portfolio. So the portfolio itself is going to have less risk as you add fixed index annuities to it. And for the most part, as you substitute the bonds out and put in the fixed index annuities, we would mostly predict that the fixed index annuities would outperform the bonds. So they may actually maybe the kind of the perfect good storm here, where you end up with potentially less risk but more upside.
So it sounds like that's a positive effect on a traditional efficient frontier then, right?
Well, it's definitely a positive effect. Of course, efficient frontier means you want to get the highest return at the least risk. And here we're lowering the risk and we're raising the return. And so that's exactly what you would like as an investor.
So one of your areas of interest over the years has been investor behavior. So with the markets, again, hitting record highs this year, is greed one of those emotions that can adversely impact pre-retirees?
Yeah, I would say it's not only greed, it's actually, I would say both fear and greed are the sort of the key ingredients of an investor, because when things are up, they want to be all in. But then as soon as things drop a bit, they get very fearful. They would tend to, on their own, to swing, perhaps, with the markets. What we're trying to really do is actually satisfy the behavioral characteristics of people, which I guess we could sum up as fear and greed. So on the fear side, with the principal protection, once you alleviate that fear, people are actually willing to have some equity exposure. Of course, they wanted that equity exposure when markets are up, and if they didn't get it, they get greedy and they figured, I should have done that. I should have been in the equity market. But of course, when the equity market goes down, they said, well, I shouldn't have been in the equity market. Well, you've got that combination of fear and greed, which kind of paralyzes people here. And this is what FIAs are really designed to take care of here, because we protect against that fear with the principal protection. And we actually satisfy their greed to some extent by participating with equity exposure in these products. And so now if the markets are up and they have good returns, they're not upset anymore, because they can be upset by just not being in the market. On the other hand, when the market's down and they are principally protected, they're not upset. So I said this was tailoring. There really are, these products are really tailored to meet the behavioral needs really of investors, because they have on their own they would have very much difficulty in actually taking on equity risk.
How prepared are you? Dr. Ibbotson is doing a great job of teaching us about the power of the fixed index annuity. And we'll get right back to the podcast in just a second. But how prepared are you to integrate his research into building a more sustainable business? At InsurMark, we have a proprietary value engineering process that helps growth-minded advisors get more out of their life's work. Advisors engaged with us in this process are realizing more client time, more family time, and more value from their business. That's what we call driving business alpha. So check out our value engineering video at insurmark.net to learn more. Now, let's get back to Dr. Roger Ibbotson.
So we spent most of this podcast talking to Dr. Ibbotson. I'd like to turn to John Holmgren, who's president of Zebra Capital Management. John, I understand your firm has developed a new index for use in FIAs. Can you talk a little bit about how that works and why investment advisors should be considering it?
Yeah, that's right, Jack. We have. If you look at the white paper, Fixed Index Annuities Consider the Alternative, we did that in such a way to make it more of an academic study where we looked at a generic index, which would be similar to an S&P 500, a large cap generic index, on an uncapped basis. And really what we did is we created the NYSE Zebra Edge Index, which is then utilized in the nationwide New Heights platform to create an FIA that's really harnessing these aspects that Roger was talking about, particularly the idea of popularity. And we want to have the less popular stocks that are also lower volatility, which then increases the exposure of the index that can actually be utilized in a risk-controlled environment. So we're using a behavioral finance-derived investment philosophy that's designed to avoid and then also to exploit the behavioral biases that Roger just talked about. And this is implemented in a systematic way that is designed to dynamically allocate between the equity index as well as the risk control to maintain that 5% volatility. And in doing that, we've really created a product that's really designed, again, as Roger had referenced, for long-term investors who are looking to de-risk their portfolios, yet participate in the upside of the equity market while having a capital protection. And that's really kind of what we've done and how this whole process has evolved.
So should investment advisors look at that index a little bit differently than what we were talking about earlier with respect to FIAs? How should they be applying it?
Well, it's really in the FIA context, in the, as approaching retirement or in the accumulation phase, the latter stages of accumulation of assets, looking at a way of de-risking. So again, back to the idea of a bond substitute as doing that, where the investor can get, again, someone who's willing to invest long-term, or I want to be very clear that these strategies are not for everybody, but they're for longer-term investors who are looking at a allocation for a certain time period, and looking also post-retirement as well, because as you asked earlier about people in early stages of retirement or mid stages of retirement who really want to have a flow of income, who cannot withstand a sharp drawdown. That's really what this is for. So it really fits into that context. I don't really want to say that it's a new asset class, but it is an asset class that fits in, somewhere as a hybrid between equity and bonds, but giving you the similar volatility to bonds, but with higher upside potential.
Well, this has been really enlightening, and I want to thank you, John, and I want to thank you, Dr. Ibbotson, for taking the time to educate us about FIAs as a bond alternative. We also want to thank Annexus for making the Zebra Capital team, the new Zebra strategy, and particularly Dr. Ibbotson's work accessible to all financial advisors. And we want to thank all of you who are listening, and we'll see you soon on the next JTalks podcast.
Well, that was a powerful conversation. We have a simple way for you to get your copy of his white paper, along with info about the nationwide and the NYSE Zebra Edge Index that John Holmgren talked about. Go to InsurMark.net and click on the Ibbotson podcast button. It's that simple. Thanks to Annexus for making Dr. Ibbotson and his research available today. If you've got questions about FIAs, insurance, or driving business alpha, please call one of our advisor development consultants at 800-752-0207. Stay connected with future episodes by subscribing today and keep posted on all our offerings by following InsurMark on LinkedIn.